All right, so our next chapter that we're going to study is inventories. We've covered cash, we've covered receivables, and inventories are going to be our next topic, and I think that you'll find it to be a wonderfully enjoyable chapter. And so along those lines, we have some learning objectives. We're going to talk about internal control over inventory, the entire inventory process. And then we are going to introduce something called cost flow assumptions. And we have those here. We'll get into those more in the following slides. And then finally, depending on which specific cost flow assumption a company uses, there will be implications for the financial statements, specifically the income statement and the balance sheet. Okay, so we discussed back when we were having our discussion of internal control and cash. I guess we should say that, we introduced the topic of internal control as it pertains to cash because cash can be ripped off, both from internal theft and from external threats as well. And then we talked about our next topic was receivables. And we kind of got away from internal control. But now we're talking about inventory. And aside from cash, inventory is probably the most vulnerable asset a company has. And then after that probably would be some of the larger fixed assets. But we tend to notice when those go missing, right? So we have a 3-step process here on your slide for safeguarding inventory, and it starts with this purchase order. A purchase order is simply someone in the company saying, hey, this is what we need, and I want permission to order it, or I'm telling you that I need it and I want you to order it for me. Okay, so the purchase order is not necessarily the exact order that we're going to send in, but it gives us essentially permission to make the order. Once the order has been placed, at some point goods will be received by the company that ordered them, and when that happens, someone in the receiving department will fill out a receiving report, and this will basically be 10 boxes come in. We open the boxes and we count what it is we have. Maybe all 10 boxes are the same item, which makes it easy. Or maybe we have 20 different items spread out over those 10 boxes. So someone in the receiving department will merely say, hey, I got 12 of product A and 9 of product B and so on. And all they're going to do is count. They're not going to have a packing list in this or anything. And there's a reason for that. We want them to count, not knowing how many were ordered in the first place. So very important that we understand the people who do the purchase order and the people who do the receiving department. We have to have separation of duties there. Those cannot be the same two people. And then finally, we have the vendor's invoice. We want the vendor's invoice for a couple of reasons. We want to make sure that the vendor's invoice matches their receiving report. If we got 10 of something, we don't want to pay for 12. And then we also want to make sure that the vendor's invoice at least roughly matches the purchase order. If we ordered 3 of something and we were sent 10, that's a problem. But if we ordered 10 and we only received 3, even if that's all we were billed for, well, that's kind of a problem too. So these are these 3 items we have. So we're going to have a purchase order to receive, to order the product. Then we're going to have a receiving report once we get it. And then we're going to use the vendor's invoice to make sure that everything is okay before we actually pay for those goods. All right, so we've discussed this. slide already. It says the price, quantity, and description of the item on the purchase order and receiving report are compared to the vendor's invoice before the inventory is recorded into the accounting records. And as I said, also before we actually go ahead and pay that invoice. I want to talk to you a little bit about this concept of a subsidiary inventory ledger. Now, we talked about back in our discussion of accounting for retail businesses that have inventory, for example, we talked about two different types of inventory methods. We talked about, or inventory systems would be a better way to put it. We talked about the periodic inventory system and the perpetual inventory system, and we have a mention of the perpetual inventory system right here. And just as a to kind of go this again, with a perpetual inventory system, every time we make a purchase, it's added to our inventory. And every time we make a sale, whether it's 1 unit, 2 units, 10 units, whatever, those sales subtract out. So if we think about it, what is a subsidiary inventory ledger? Well, it is a ledger for each individual product that we carry. Okay, so I had, when I had the music store, I had about, in one music store, we would have about 30,000 pieces total. At any one time would have about 800 to 1,000 different titles that were brand new. I sold both new and used. And then of those 800 to 1,000, maybe 400 titles that I was actively ordering and reordering. Some of them you get them and you just let them expire on the shelves or send them back. But other titles, you want a minimum of 1 copy in stock. Stronger titles, maybe 5 or 10. And so what these subsidiary ledgers do is it allows you to look up one individual piece of inventory and say, okay, in the last 1 week, I've sold 7 of these, and now I have 3. Well, that's a pretty good indication that you probably need to order some more. So the subsidiary inventory ledger is very, very valuable in terms of helping you maintain the correct amount of inventory. In other words, we don't want to run out of the inventory, but we also don't want to have too much inventory. This slide also talks about some physical controls that we can use for safeguarding inventory, such as storing inventory in restricted areas, accessible only by authorized employees, locking inventory away, and then using technology such as cameras, security tags that beep when the item leaves the area, two-way mirrors, and guards. I guess guards are not exactly technology. Okay. It says here that a physical inventory or count of inventory should be taken near year end to make sure that the quantity of inventory reported in the financial statements is accurate. Now, I want to say this. Notice there's nowhere on this slide that indicates whether we're talking about a perpetual inventory system or the periodic inventory system, and that's because we need to do this regardless. With a periodic inventory system, we'll get into the reasons why we absolutely have to do it. But even if we're using a perpetual inventory system that helps, where we're tracking inventory with every single transaction, we still need to take this physical inventory account because things happen. Items get lost, damaged, stolen. Sometimes we might code inventory incorrectly. So even if we use a perpetual inventory system, we always have to take a physical count and reconcile our inventory at the end of the period so that our financial statements are as fairly presented as possible. All right, so I'm going to let you look over this slide primarily on your own, but I will point out a couple of things when we talk about these cost flow assumptions. I'm going to go over this slide just a little bit. We have three that we're going to discuss in this chapter. We have what is called first in, first out, otherwise known as FIFO cost flow assumptions. We have last in, first out, or LIFO costing method, and then we have what's called weighted average cost. And if we look at these little diagrams, it'll help us a little bit here. What we're saying is, if this is our stock of inventory here, this box, whatever we put in first is assumed to be the item that is sold first. Okay? So our inventory that we have left over up here at the top is going to be our most recent purchases. The stuff that we expense to cost of goods sold over on the income statement is the oldest merchandise that we have. LIFO is the exact opposite. Whatever we put in, we expect that's what's going to be sold first. And so our inventory, which is down here at the bottom of the box, is our ending inventory is made up of our oldest purchases. We're going to expense to cost of goods sold our most recent purchases. So it's more of an in and out type thing. And then with weighted average cost, you see we have this diagram here right in the middle. That's to kind of indicate that we're going to take all of the items ordered, divide that into the total cost, and then whether it's the first item in, the last item in, doesn't matter. We're going to expense our cost of goods sold based on that average price. And then our ending inventory, whatever we have in terms of quantity, we're just going to multiply by that average price, and that's going to make up our ending inventory. I think this will make more sense to you once we actually get into some exercises. So continuing on, it says inventory cost flow assumptions. It says assume that 3 identical units of merchandise are purchased during May. We've got 3 dates, 10th, 18th, and 24th, and each purchase is for 1 item. So 1 plus 1 plus 1 is 3. But notice that our costs go from $9 on the 10th to then $13 and then $14 on the 24th. So if we add these 3 numbers up, we come up with a $36 total cost, and our average cost per unit is $12. The $36 total cost divided by 3. But that doesn't mean that's exactly how we're going to expense these items or count the inventory. Okay? All right. So, real quick, and then we'll go ahead and end this slide. It says, assume that 1 unit is sold on May the 30th for $20. Well, depending on which unit specifically was sold, the gross profit's going to vary anywhere from $11 to $6. Recall our conversation or our discussion of retail businesses. Gross profit is merely what? It's sales minus cost of goods sold. So what we're saying here is that depending on how we do this, if we're using the FIFO method, which don't worry, we're going to talk about that soon enough, our sale is $20. That oldest piece of inventory is what we're going to expense to cost of goods sold, only $9, leaving us with gross profit of $11. How did I get 11? I subtracted 9 from 20. That gave me $11. And ending inventory is $27 because it is assumed that I have the $13 item and the $14 item still in stock. Okay. Over here we would have an example of LIFO. $20 is still our sales price. Cost of goods sold is $14. Why? Because I'm expensing the newest item. So my gross profit is less, and my ending inventory is also going to be less because I have the most recent purchase and the second purchase there. Okay, so if you're having trouble and you're scratching your head a little bit with regard to these inventory cost flow assumptions, inventory cost flow methods, I would tell you to stick with it as we get into some examples, both in the PowerPoint video and in the handout videos that we do. I think that inventory will start to make a whole lot more sense.